All right, so this is problem number 15. I had to make a quick adjustment on the previous homework assignment, so I adjusted your homework question. So this is actually the new number 15. And on this particular problem, you're dealing with the note and the interest that you're going to have to pay on the note payable. So for this particular problem, they do a lot of retail. I'll just kind of skip to the main part of the problem, but they sell a lot of their merchandise around Christmas. And because a lot of their sales are on credit, they don't have a good cash flow, so they have to borrow money. So on November 1st, it says that Mattel borrowed $6 million cash. The note matures in 6 months. Interest rate is 8%, payable at maturity, and the accounting period ends on December 31st. So we got to watch the dates here. So November 1st is when they borrow the money, and on December 31st, again, is the year end. So to deal with the borrowing is very simple. You just debit cash, credit notes payable for that $6 million. And then notice 2 months later, you're going to have to do an interest accrual. So remember the concept of the interest is you've got to take the principal times the rate times the time. So in this case, it'll be that 6 million multiplied by the interest rate of 8% times 2 over 12. The reason it's 2 over 12 is because you got November and December. That, of course, is 2 months later. And of course, that'll give you $80,000 of accrued interest. And then just to kind of finish that calculation, going into the next year, you'll still have that same principal times the 8%, but because you got 4 months left on the note, the next 4 months, it'd be 4 out of 12. And so the rest of the interest would give you $160,000. So 80 plus 160 would give you 240 in total. So to finish this problem, for the second entry, this would be your interest accrual, debit interest expense, credit interest payable for that 80. And then notice you're into the next year, the 4th month of the next year, you pay off the note. There's a principal, debit notes payable. You debit the interest payable that you accrued at December 31st, that 80,000 gets paid off. Then you got to report the interest expense for the new year. There's the 160. And then the credit to cash would simply be all your money. It's going to be the principal plus all of your interest of 240, so credit cash for 6 million, 240. Of course, here's the same calculations down below. All right, so that is problem number 15. Now on 16, the way I did this is on 16 and 17, it's going to look like the same problem, but on 16, the difference is on 16, we're going to do the straight line method, and then on 17, I wanted to show you to compare that with the effective interest rate method. So in this problem, they sold some bonds, 328 for 11% bonds. Market rate's 8%. Again, this happened on January 1st. Bonds pay more than the market, so it's a premium bond. The face of the bond's 250. Interest is paid December 31st, mature in 10 years. Again, using straight line method. So the issuing of the bond is on January 1st. You debit cash for what they received. Always credit bonds payable for the face amount. And of course, the difference, what they're receiving above the face is called the premium. So it's called premium bonds payable. So after that, then when you do the interest, what you got to do is you got to do that amortization. So the bond premium is $50,328. So because interest is paid annually once a year for 10 years, you're going to divide this by 10. Rounding that off, you're going to get 5033. It's roughly 5033 per year. Again, that's going to be your amortization on the bond premium. And typically you do that, you pair that amortization up every time you make an interest payment. Now, the interest payment will be the 250 face, multiply that by 11% times 12 over 12. So 11%, again, that's the stated rate on the bond. And that interest payment will be right at 27.5. So once you get that, you would take that interest payment of 27.5, subtract out that amortization of 5033, and that would be what you would report as interest expense. So in this case, if you look at the entry, you're debiting the premium. There's your amortization of 5033. You are debiting interest expense for that difference, which is 22,467, and crediting cash for 27.5. So sometimes what they used to teach me is that think of it when you're doing the straight line method is that the interest expense calculation is simply just a plug number It's the difference between what you pay and what you amortize. Now, I'm telling you this because when we look at the next problem, which is going to be essentially the same data, you can see how the interest expense changes under the effective interest rate method. I'll show you that in a minute. All right, so again, down below, they're just showing you right here. They're just showing you the same calculations that I just showed you. Okay, so having said that, let's check out, I believe this will be your last problem. And again, everything is the same except they're using effective interest rate method. So you'll notice the first entry, there's no difference. You debit cash, credit bonds payable for the phase. Here's your premium of $50,328. Now, when you get to the second part on your interest payment, here's what's going to change. Because it's the effective interest rate method, you use the carrying value, and the carrying value of the bonds is $300,328. So your initial carrying value is always simply what you received. And so if you want to look at it that way, or you could say it's the bond payable, which is $250. And in this case, it is plus the premium on the bond of $50,328. That's how it would be presented, of course, on the balance sheet. So you've got your carrying value, and what you do with that is you multiply that by the market rate. Now, the market rate in this case is 8%. So if you take that times the market rate, and again, times 12 over 12, that's going to give you your interest expense. So note, for this method, your interest expense, again, this is December 31st, that's going to give you, there's where they get this $24,026 roughly. That's a direct calculation. And then you'll notice that the cash payment of $27,500, that doesn't change. That's still your face amount multiplied by the stated rate of 11%. Again, in that case, again, times 12 over 12. Again, that's where they get that $27,500. That's no different than the problem 16. So that's the same. So your cash payment's the same, but notice the interest expense is a direct calculation. So what happens is the amount that you're going to write off or amortize, that then becomes the plug number, which you're going to get 3474. That's the difference. So just kind of comparing and contrasting effective interest rate method with the straight line method. When you do the interest for effective interest rate method, the interest expense is a direct calculation right here. The premium amortization is a plug number, right? Cash payment is the same. Straight line method, you'd have cash payment of still $27,500, but the amortization would be the same number. You'd fix that one. That's going to be a direct calculation. And the interest expense would be the plug number under the straight line method. So you can use this video and kind of go back and forth between problems 16 and 17 and make sure you study the differences and similarities between the straight line method and the effective interest rate method.